The app says 0. The next statement says interest. Both can be accurate at the same time.
That sounds impossible because 0 feels final. You made the payment, the balance disappeared. You may have even stopped using the card. Then a new statement arrives with an interest charge attached to debt you thought was gone.
The first reaction is usually simple. The bank must have charged interest after the debt was paid. But that explanation misses the part of the account that the screen does not show clearly.
A credit card balance is not one continuously updated final invoice. It is a series of snapshots taken at different points in a billing cycle. Your statement captures one snapshot. Your app shows another. The payment system records another. Interest can be calculated across the days between them. That gap is where the extra bill begins. Imagine a card statement closes with a balance of $3,000. The account has already been carrying debt, so the purchase grace period is no longer protecting that balance. The statement is created, but the payment is not received until 12 days later. During those 12 days, the debt still exists. Many card issuers calculate interest daily using a daily periodic rate. That rate is generally based on the annual percentage rate divided by either 360 or 365, depending on the issuer and agreement. So while the statement shows the amount calculated through its closing date, additional interest may continue accumulating until the payment is received.
Using a simplified example, a $3,000 balance at a 24.99% annual rate can generate roughly $25 of interest over 12 days. The exact amount can differ because issuers use different calculation methods, cycle lengths, compounding rules, transaction categories, and posting dates. But the important part is not the exact $25, it is the timing.
The statement did not promise that interest would stop on the day the statement was created. It showed what had been billed through that statement cycle. Then 12 more days passed before the money reached the account.
Now, look at the same sequence from the app. On day 1, the statement closes at $3,000. On day 5, you schedule a payment for $3,000. On day 7, the payment leaves your checking account. On day 8, the card issuer receives and posts it. The visible posted balance can now fall to 0. But the interest created between the statement closing date and the payment date may not have been included in the payment you submitted. It can remain unbilled until the next statement closes. So the 0 was real. The later interest charge can also be real. They were measuring different moments. This is often called residual interest or trailing interest. The name makes it sound like a special fee hiding at the end of the account. It is usually not a separate fee. It is interest tied to the days when a carried balance was still outstanding, but the charge had not yet appeared on a statement. That distinction matters because many people respond to the surprise charge in the wrong way. They assume the payment failed. They assume the issuer restarted the debt. Or they pay the small interest amount and immediately begin using the card again, believing the account has returned to its normal interest-free cycle. That last assumption can be more expensive than the original surprise charge.
A grace period is the window that can allow purchases to avoid interest when the required balance is paid in full by the due date. But once a balance is carried, that protection can be lost. Depending on the card terms, new purchases may begin accruing interest from the date each purchase is made.
So the real risk is not only one final charge of $25. The real risk is believing the account is interest-free again when the grace period has not yet been restored. Picture what happens next. The old balance is paid. The app displays 0. A person uses the card for groceries, fuel, and one online purchase because the debt appears finished. None of those purchases feel like borrowing. They feel like normal spending that will be paid on the next statement. But if the grace period is still unavailable, interest may be building on those new purchases from their transaction dates. The card can look clean, while the next layer of interest is already forming. At this point, the obvious solution seems to be paying whatever number appears in the app one more time. but that can repeat the same mistake if the displayed number is only the current posted balance and does not yet include interest still moving through the cycle.
The useful question is not whether the screen says 0. It is whether the issuer considers every balance category, bill, charge, and accrued interest amount fully satisfied under the card agreement.
That is why two people can make what looks like the same full payment and get different results. One kept a grace period. The other had been carrying a balance.
One paid a statement balance. The other confirmed a current payoff figure with the issuer. One stopped making purchases. The other added new transactions before the account had returned to its normal grace period status.
This changes the mystery. The question is no longer only why one interest charge appeared after 0. The larger question is this: when does 0 actually mean the interest cycle has ended?
0 becomes meaningful only when you know which 0 you are looking at. The statement balance is the amount shown when the last billing cycle closed. The current balance usually reflects transactions and payments that have posted since then. Neither number is guaranteed to display every cent of interest that may still be accumulating but has not yet been billed.
That is why the next step is not to keep sending random small payments every time the number changes. It is to reconstruct the account.
Start with the statement closing date. This tells you when the issuer took the snapshot used to create the bill. Then find the date your full payment was received or posted. Do not use only the day you pressed the payment button or the day the money left your checking account. The important date for the interest timeline is generally when the card company received the payment. Now count the days between those 2 points. If you had been carrying a balance, those are the missing days that can create residual interest. The amount may be small, but it is not random. It is connected to the balance, the annual percentage rate, the daily calculation method, and the number of days the balance remained outstanding.
Next, examine the new statement. Look for the transaction category attached to the charge. Purchase interest, cash advance interest, balance transfer interest, promotional financing, and fees can follow different rules. A card can contain more than one balance category at the same time, each with its own rate and treatment.
This matters because a charge that looks like residual purchase interest may actually come from a cash advance, a balance transfer, a deferred interest promotion, or a transaction that posted after the payment. The account timeline must match the category. Then check the section explaining how the issuer calculates interest and when the grace period applies. The language may not be pleasant to read, but it answers the central question: what must happen before new purchases stop generating interest?
Do not assume the answer is identical for every card. Some accounts may restore purchase grace period treatment after the required balance is paid in full under the agreement. Other situations may require another complete billing cycle or satisfaction of additional conditions. The issuer's terms control the result.
That creates a practical rule. If you have just paid off a card that was carrying debt, avoid treating the first visible 0 as permission to resume normal spending until you understand whether residual interest remains and whether the purchase grace period has returned.
This is not because using the card is automatically wrong. It is because adding new transactions can make the old interest and the new interest harder to separate. A clean account is easier to verify. When the visible balance reaches 0, contact the issuer through the number on the card or statement and ask a precise question. Ask whether any accrued but unbilled interest remains. Then ask what amount would satisfy the account as of the payment date. Finally, ask whether the purchase grace period is active again, and if not, what condition restores it.
The useful phrase is not, "Why are you charging me again?" The useful phrase is, "Please explain the dates, balance category, rate, and calculation that produced this charge." That changes the conversation from frustration to evidence.
If the explanation matches the statement closing date, payment receipt date, outstanding balance, and card agreement, you have identified the mechanism.
If it does not match, ask for the calculation in writing and use the issuer's billing error process when appropriate. Keep the statements, payment confirmations, and any written responses. A surprise charge is not automatic proof of an error, but the issuer should be able to explain how it was calculated. Now return to the original contradiction. The app said 0 because the posted balance had been paid. The next statement showed interest because some interest belonged to days that were not included in the earlier snapshot. The screen was showing the account's visible present. The statement was finishing the account's recent past.
Once you understand that, the final bill stops looking like debt that came back from nowhere. It becomes a timeline you can inspect. So use 4 checks whenever a paid-off card produces another charge. Check the statement closing date. Check when the issuer received the payment. Check whether the card had already lost its purchase grace period. And check whether the amount you paid was merely the displayed balance or a confirmed payoff amount that included accrued interest.
Save this video before your next credit card payoff. The number that matters is not only the balance you can see, it is the balance, the missing days, and the rules connecting them. Because 0 is not always the end of the story. But once the timeline is visible, the story is no longer a mystery.